What's up, everybody? This is Sunko, the Korean bro, and today is 2023, January 1st, the first day of 2023, and I feel great. Uh, anyway, okay, let's see. What articles am I going to read tonight? This company sales soared 2,250% in 9 years, and now its stock is cheaper than ever. One supercharged growth stock to buy like there's no tomorrow. Here's the next stock I'm going to buy. Where does Tesla stock go in 2023? Two remarkable growth stocks down 92% and 97% to buy before the next bull market. 80% of Warren Buffett's portfolio is invested in these seven stocks as 2023 begins. NASA BMR 5 extraordinary growth stocks regret not buying on the deep. Okay. First one's first. Okay, let's see. Meta platform stock is down 65% over the past year because of a mixture of internal and external challenges. The company is introducing a series of new features into its core social media apps to fight off a big competitive threat. Despite this tough period, investors should keep the long term in mind because Meta has an incredible track record of success. Here's why Meta Platform is having such a tough 12 months despite strong track record of success. Meta Platforms. In the year 2018, its revenue was 55 billion. 2018. Okay, let's see. A couple of months ago, I read an article about Meta Platforms and their trial with AI. Not AI exactly. Their trial with Metaverse wasn't as successful as people had thought it would be, and ever since that news came out, people have been really negative in terms of investing into Meta Platforms, and it hasn't made that much profit ever since they started doing some experiment with Meta Platforms, Metaverse. So people don't have high expectation with this company, but we all know that they have a lot of intelligent people who's been main source for this company's growth, and we all know that we cannot deny their future potential from that perspective. So let's read this article and look at what this author thinks. 10 years ago, Meta Platforms went public as Facebook. The social media giant, which owns popular platforms Facebook, Instagram, and WhatsApp, had been seemingly unstoppable as a public company until it ran into a series of headwinds over the last 12 months. For the first time, Meta's annual revenue earnings per share are set to shrink in 2022 compared to the year before. As it grapples with a more competition and a tough economic climate, but the company has a stellar track record of success. And this isn't the first time it has faced a mammoth set of obstacles. So far, it has surmounted them all, growing its revenue more than 20-fold in the 9 years between 2012 and 2021. Now its stock is cheaper than it has ever been. Meta platforms. Ever been? Um, Here's why its shrinking financials in 2022 might just be a blip on the path to more long-term success. Here's what went wrong at Meta platforms in 2022. Hmm. A mixture of internal and external factors led to a disappointing 2022 for Meta platforms, which saw its stock decline by 65% in the past 12 months. Internally, Meta's focus on building a virtual world, the metaverse, was met with widespread criticism from the investment community. Yeah. Well, their experiment with what a metaverse was criticized from the investment community. Uh, Obviously, the company burned $9.4 billion on the project in the first 9 months of 2022 alone. And since meaningful revenue is 5 to 10 years away, this has put a dent in its financial results. But CEO Mark Zuckerberg thinks the metaverse will eventually attract 1 billion users who will each spend hundreds of dollars on digital goods. Zuckerberg is not alone. An estimate by Bloomberg Intelligence says the metaverse could be an $800 billion opportunity as soon as 2024. Externally, high inflation and rising interest rates have crippled household finances, which has led to business trimming their marketing spending, displaced pressure on Meta's core business selling advertising spots across its family of apps. So, inflation and high interest rate has put a lot of burden on their mm, company's growth. Extremely high inflation and rising interest rates have crippled household finances, which has led to business trimming their marketing spending, displaced pressure on Meta's core business selling advertising spots across its family of apps. Plus, Meta has faced major competition from ByteDance's TikTok, which has become the world's most popular and fastest growing short form video platform. It's reshaping the way users interact with social media and it's attracting a very young audience, which is stealing ad dollars away from Meta's core brands. TikTok is another SNS platform where a lot of young users um, use. Because of that, uh, uh, they are stealing dollars away from Meta's core brands. Hmm. Meta has a stellar track record of success. Competition hasn't stopped Meta in the past. Once they make MySpace's launch and crush competitive threats from Snap by borrowing its story concept and integrating into its own apps. Plus, Meta has watched other players come and go, like video-based platform Vine. Now, Meta is building short-form video into Instagram and Facebook uh, to challenge TikTok. It's also introducing new features like Notes, which is designed to make Instagram's chat feature more engaging, and Candy Stories, which borrows a lot of content sharing concept from the new fast-growing Be Real app. The ability to adapt to a rapidly changing social media landscape enabled Meta to grow its revenue by a whopping 2,250% in 9 years. So in the 9 years, they've grown so rapidly. Between 2012 and 2021, but its a 2022 result is expected to come in slightly below last year's once the company officially releases its annual financial report in February. Meta's profitability is also set to take a hit in 2022. In the recently reported third quarter, the company delivered $4.3 billion in net income, which was a 52% drop year over year, and it's $3.6 billion quarterly loss showing the metaverse project was partly to blame. Cheaper than ever. Okay. Based on its projected revenue of $116.1 billion in 2022 and the company's current market capitalization of $309 billion, Meta's price to sales ratio is just 2.7 right now, which is the cheapest level in its history dating back to its IPO days a decade ago. Similar based on its projected earnings per share to $908 for 2022, the current share price of $116.73, Meta's price to earnings ratio stands at just 12.8 at the moment. That's where a big opportunity might exist. Meta's official financial results might shrink in 2022, but considering all of the new features it's rolling out across its family of apps, plus its recent cost cuts, the long-term potential of the metaverse, it seems unlikely those difficulties will persist in the long run. Additionally, economic headwinds like high inflation that have hurt consumers and forced business to cut their advertising spending might be steadily resolving, which could help reignite Meta's growth. Okay. Meta platforms. Not a big market. One supercharged growth stock to buy like there's no tomorrow. While all three major U.S. stock market indexes have plunged into bear market territory in 2022, the tech-centric Nasdaq has been hit the hardest. Harsh as they might be, market downturns have historically represented the best opportunity for long-term investors to buy shares of quality companies at discount. The trade desk has been ranking up impressive growth in spite of the macroeconomic conditions, setting the stage for a big rebound later on. Okay. Investors would do well to remember that bear markets, as difficult as they are to endure, and are not only a natural part of the economic cycle, but have historically provided investors with the opportunity to buy top-notch companies at discounted prices. Also, very previous bear market has eventually ceded ground to bull market, which usually charges out of the gate, enriching investors as stay the course. One bear market bargain that looks particularly ripe for the picking is AdTech Litter, the trade desk. The stock is down roughly 61% from last year's high, but a look under the hood shows investors should be buying this stock like there's no tomorrow. The trade desk. Okay. The ad industry is in the midst of a paradigm shift with digital advertising expected to account for more than $0.60 of every marketing dollar in 2022. Automating digital ad buying in real time has revolutionized the industry and is at the head of everything the trade desk does. CEO Jeff Green pioneered the world's first online advertising exchange and continued to disrupt the otherwise staunch industry. The trade desk transparent pricing made customers of the world's largest ad agencies, but its disruptive technology has kept them coming back for more. Its platform boasts cutting edge technology with the ability to evaluate more than 9 million ad impressions and quadrillions of permutations every second. While rivals bemoan the death of cookies and the hardships of consumer privacy measures, the Trade Desk developed Unified ID 2.0, which will provide marketers with the data they need without the need for personally identifiable information. Additionally, the latest generation of its platform lets marketers seamlessly incorporate first party information, further improving its already impressive data driven results. The state of the art technology generates industry leading outcomes. The results speak for themselves. When you compare the Trade performance to that of its two largest competitors, the results speak for themselves. In the third quarter, Alphabet's revenue grew by a partly 6% year over year, while sales at Meta platforms actually declined 4%. At the same time, the Trade Desk revenue jumped 31%, showing that the company is stealing market share from others in the industry. Helping drive this growth is a host of happy customers and industry accolades. The Trade Desk was recognized as a 2022 Customer Choice for EdTech, according to Gartner's Peer Insights rankings. The Trade Desk named the leader in Quadrant's 2022 Smart Metrics for EdTech platforms, rank, ranking highest among customer impact and technology excellence. It was also identified as the leader in the Forest Research's Way for Business to Business Advertising Solutions, earning the top score in cross-channel capabilities criteria and among the highest scores in the Innovation Roadmap criterion. A large and growing opportunity. Advertising continues its ongoing shift to digital, and the Trade Desk is well positioned to benefit from that secular trend. The company generated revenue of $1.1 billion last year, a drop in the bucket compared to its massive opportunity. The global ad industry is expected to hit $8 to $8 billion in 2022, surging to more than $1 trillion by 2026. This helps illustrate the long runway for growth remains for the Trade Desk. All this potential doesn't come cheap, at least in terms of traditional valuations metrics. The Trade Desk currently trades for 11 times next year's sales, where most experts agree a reasonable price to sales ratio is between 1 and 2. However, companies with a strong history of growth and bright future prospects are frequently awarded premium valuations. The Trade Desk certainly qualifies. That said, given its history of above average growth, even in the face of macroeconomic headwinds, significant opportunity for continued growth and continually evolving disruptive technology, the Trade Desk should experience a significant rebound when the economy recovers. And when it does, investors will wish they'd bought more of the Trade Desk while the stock was down. Okay. And one that we have next is Lulumon. Hmm. What's up with Lulumon? Okay, let's see. Attractive valuation mixed with stellar growth makes this business a no-brainer portfolio addition. Lulumon. Lulumon. Lululemon Athletic, together with its subsidiaries, designs, distributes, and retails athletic apparel and accessories for women and men. It operates in two segments. Company operates stores and direct to consumer. The company offers pants, shorts, tops, jackets for healthy lifestyle, and athletic activities located at Vancouver. Okay. Mm. Okay, let's and let's look at this one. Roku is the most popular video streaming platform in the US, Canada, and Mexico, and management is working on an ambitious growth strategy. Upstart aims to disrupt the multi-trillion-dollar lending industry with artificial intelligence, and its platform appears to quantify credit risk more effectively than vehicle-based models. It's what we covered over the last couple of months, but mm, but the reason why I'm reading this over and over is because by reading this, there's a piece of information that I never knew before, and like by reading it continuously, I really know that I can get to really know that they still have potential nowadays. Like they could possibly have potential in the way back, but then if like article like this doesn't come out, I could just guess that they don't have that much potential. But if this kind of article still comes out, that means they still have potential, right? So uh, it's kind of like a double check uh, system. Anyway, the stocks could rebound once investors start to feel more confident in the direction of the economy. Warren Buffett once told investors they must remember two things. First, widespread fear is your friend as an investor uh, because it serves up bargain purchases. Second, personal fear is your enemy. Hmm. Those words are worth revisiting in today's economic climate. During the past year, all three major U.S. stock market indexes fell into bear market territory. All three major U.S. stock market indexes fell into bear market territory, dragged down by high inflation, rising interest rates, and recession fears. But smart investors know that fear-driven downturns are buying opportunity. Not because every beaten down stock will recover, but because they leave many companies dreaming with potential trading and discounted valuations. There are two growth stocks that fit that later description that I see as excellent buys before the next bull market. Hmm. The most popular streaming platform. Many brands have cut their ad budgets as discretionary consumer spending has softened in response to high inflation. The trend led to disappointing third quarter results for Roku. Its revenue climbed just 12% to $761 million, a considerable deceleration from its 51% growth in the prior year period. It reported a GAAP loss of $0.88 per diluted share, down from a profit of $0.48 per diluted share a year earlier. Those results contributed to the continued sharp decline in Roku's share price, which was set in motion by broader economic uncertainty and business challenges. This is a good time for investors to step back and consider the big picture. Streaming media is undoubtedly still taking audience share from traditional linear television. Is undoubtedly still taking audience share from traditional linear television. Streaming media is undoubtedly still taking audience share from traditional linear television. Roku is the most popular streaming platform in the US, Canada, and Mexico as measured by streaming hours. Okay. In other words, Roku is engaging viewers more effectively than its competition, which makes it a particularly valuable partner to content publishers and advertisers. Additionally, management has outlined an ambitious growth strategy that aims to supercharge engagement and strengthen the moat around its business. The company is investing in content um, for ad supported streaming service, content for its ad-supported streaming service. The Roku channel and those investments are paying off. Mm. In the third quarter, the Roku channel once again ranked among the top five channels on the platform in the US in terms of engagement. Roku is also expanding into smart home devices, including cameras, video doorbells, and lighting. Um, that may seem like an odd direction for the company to growth, but Roku is already the top-selling smart TV operating system in the US. So the company has technology and expertise in hardware, software, and services to deliver a smart home ecosystem that's simple, powerful, and delightful, according to CEO Anthony Wood. Finally, Roku is expanding internationally at a measured pace. It brought its ad business to Canada in 2021, and it brought its ad business and the Roku channel to Mexico in 2022, expanding its revenue opportunities to nations where it ranks as a top streaming platform. Looking ahead, Roku may continue to struggle in the near term, but strong market position and the secular shift towards streaming media should allow the company return to profitability in the future. According to research from Omdia, online video ad spending is expected to grow at an annualized rate of 14% over the next 5 years to reach $362 billion in 2027, which puts Roku in front of a big addressable market. And with shares trading at 1.7 times sales, the cheapest valuation since Roku went public in 2017, now is a good time to buy this growth stock, especially because the company has a great shot at re-accelerating sales growth when the economic climate becomes more favorable. Okay, let's see. Offshore holdings. The shaky condition of the economy has been even more troublesome for offshore holdings, a fintech company that operates an artificial intelligence powered lending platform. Default rates on loans have trended upward as inflation has put financial pressure on consumers. And banks have tightened their lending policies in response. Meanwhile, rising interest rates have made it more costly to borrow money, causing demand for credit to decline. Hmm. That 1-2 punch led to dismal third quarter results for offshore loan origination volume dropped 48% year over year to $1.9 billion. Revenue fell 31% to $157 million, and the company posted an adjusted loss of $90 million, down from an adjusted profit of $57 million in the prior year period. Worse yet, management expects its revenue to fall by more than 50% year over year in the fourth quarter. The gloomy outlook, coupled with its disappointing financial results and uncertainty surrounding its novel business model, has knocked the stock down 97%. However, the stock is now trading at 1.1 times sales, its cheapest valuation as ever. More importantly, the underlying investment thesis for the fintech is still intact. Traditional vehicle-based credit models consider a limited number of data points, meaning banks often make lending decisions without understanding the true risk of borrower pressure. The results in higher loss rates and drives interest rates higher for all borrowers, as those who repay their loans will eventually subsidize those borrowers who default. Hmm. Upstart aims to remove those inefficiencies. Its platform considers far more data in its analysis than FICO-based models. It uses artificial intelligence to correlate those data points with the risk of fraud and defaults. Okay. And the next one we have is this one. Amazon, Lovesack, hmm, Datadog, Baidu, Datadog. Let's see. Hmm. Datadog has been covered multiple times. Let's read this one, okay? The third extraordinary growth stock you will regret not buying is Nasdaq plummets is infrastructure and security monitoring software as a service giant Datadog. Although the company's premium valuation has acted to cement blogging's share price throughout 2022, its operating performance and the shape positioning suggests the valuation premium is well deserved. Its operating performance and the shape positioning suggests its valuation premium is well deserved. Beginning with the latter, Datadog is poised to take advantage of an increasingly hybrid work environment. Beginning with the latter, hmm, Datadog is poised to take advantage of an increasingly hybrid work environment. The COVID-19 vaccines have all the millions of people to return to the office. More people are working remotely than ever before. Hmm. The COVID-19 vaccines have all the millions of people to return to the office. More people are working remotely than ever before. The ability for businesses of all sizes to monitor applications and better understand their customers is more important than ever in the post-pandemic environment. In other words, it's playing right into Datadog's strength. Hmm. And what's been particularly impressive with Datadog has been the organic growth. The company has produced 21 consecutive quarters of a dollar-based net retention rate of at least 130%. This means that the company's existing clients from the previous year are spending on average of at least 30% more in the following year. In addition, the percentage of Datadog's customers using six or more of its products had jumped from just 3% at the end of 2020 to 16% by the end of September 2022, growing from a wooden and coursing add-on sales is Datadog's secret sauce to sustain rapid growth and profitability. Growing from wooden and coursing add-on sales is Datadog's secret sauce to sustain rapid growth and profitability. Okay. The year big tech stocks fell from glory. Okay. Momentum shifted in favor of defensive and energy shares amid sharply rising interest rates and inflation. Tesla, Apple, Southwest Airlines stocks that defined the week. Stocks dropped in final trading day of year. Stocks rally as year end approaches. Okay. The dogs of tech, it's time for a bite of these dogs. Hmm. Does this acquisition make Microsoft a better market buy? Hmm. The dogs of tech, Meta platform is down 50% and recently hit bottom. Amazon is down a greater 54% and shows sign of bottom. Salesforce.com is a force to be reckoned with and may hit bottom soon. The tide has turned for Meta. If the analyst can be used as a guide, the tide has already turned for Meta. MarketBeat.com consensus sentiment and price target are down on a year-over-year basis, but the takeaway is all bullish. The consensus sentiment is firm at the moderate buy with all price still 40% above the current price action. Shares of Meta are down roughly 50% from their peak, but it hit bottom in October 2022. The bottom is marked by a spike in volume and swing in the indicators, but it is not yet confirmed. Near-term action may be mixed with a test of resistance at the 150-day EMA and a possible retest of support near $93. Longer term, the stock may trade in a broader range with a top near $206 until results confirm the outlook. Amazon, the institutions are buying it. Salesforce.com falls to more attractive levels. Okay. Amazon is getting support from analysts and institutions. Although that is not yet evident in the chart, the 45 analysts covering the stock have it set at a moderate buy that has held relatively steady over the last year. The price target down 25% year over year on a split adjusted basis is still more than 75% above the current action. Recent activity is firming, if ever so slightly. As for the institutions took a big bite of the stock in quarter third and added more than $2 or $5 billion in shares. That's about 24% of the company at recent valuations and has total ownership of up to 56%. Mm, okay. Are there any more interesting articles? Hmm. Jobs data, Fed minutes, and a fresh start for investors who want to know what to know this week. China Xi's warned of a tough COVID fight. These companies are forced to give at least 90% of their profits to investors each year. The stock market has been range bound. Don't expect that to last going into 2023. Why the consumer is critical for investors watching 2023 as a bear market not yet complete. Had the worst year ever, that doesn't make it cheap. Okay, let's see. She warns of tough COVID fight with China economy on back foot. President Xi Jinping said tough challenges remain in China's fight against COVID-19 and urged patience after weeks of silence on the virus policy pivot that's infected hundreds of millions and delivered several blows to economic activity. So China is struggling with COVID issue. A lot of people are infected, and if they don't come up with a specific policy, a lot of people will be more infected, and this will lead to a critical impact on their growth, right? Hmm. Okay, anyway, this is it for today, and I'm gonna see you tomorrow, okay? Bye bye.